So are trading indicators actually really necessary? That's the question I'm looking at in this video. We spend a lot of time, particularly when we first kick off in trading, maybe because we're taught how to use and trade with indicators, that we then go searching for the holy grail of indicators. In fact, I think just about everyone out there will have used indicators at some stage and spent a lot of time trying to perfect it, because what we want generally when we're starting off trading is something that's given us a very high probability and return us some decent money. So there's nothing wrong with that in terms of expectations. We want these sort of things to happen, and we have this expectations that indicators will do just that. They'll help us get that degree of probability and earnings. Now, of course, that's the offset, but what a lot of people do not realize is that most indicators, they're historical. They're enough, every indicator I know is historical. Even the price that you're seeing in front of you here is an historical price. The existing price, well, it's flickering quite quickly, and that's the only thing that's new on the chart. The rest of it's historical, and it's really then how we use this historical data. Now, lots of traders get tied up into, as I say, looking for indicators as the thing that's going to make the money or not make the money. So we click on here, we'll bring a couple of different indicators. We've got the RSI on at the moment. So RSI is a momentum indicator, and you'll notice it goes from sort of high levels to low levels, and you'll see that it broadly follows the price action. So if the price is moving up, so is the indicator, and at times then you're getting what a lot of traders are looking to do is trade the divergences. There's a divergence between the two highs, and that will be used as an indicator. The problem, of course, with that is, yes, in this particular example, it's looking really sweet, and it did sell off pretty nicely from that area. But of course, the frequency of it actually working isn't as good as a lot of traders would like to think it is. And so you'll get multiple times when it doesn't actually work, and you'll be stopped out, and possibly then win. But it's the amount of stoppages that really end up getting the trader, and as soon as your mental belief in something starts waning, then your potential to earn is also waning. So it goes hand in hand. So what we've got here is, yes, it's a divergence, and there's certain ways of trading it from the signal, and yes, it will work some of the time. Knowing how to trade it properly might be a part of the reason that some people don't make money from divergences, but this is one method. It's quite oscillating, by the way, as well, I would suggest, in terms of this indicator. And certainly a stochastic indicator is more of an oscillating. It will give us points where supposedly it's overbought, and periods when it becomes oversold. And sure, it will work some of the time and it will look brilliant, and if I was trying to sell this indicator to you, I could show you numerous occasions where it's got oversold here, turned the corner, and it started making money. Then of course it fails at some stage, and it'll go and stop you out. So I won't show you that bit, of course, because I only want to show you the bit that works and how easy it is to come trading with me. But that's not really what it's about. The whole thing about trading, I would suggest, is to start looking at price. And I challenge you to do this for a number of days, is just to take your charts back to nothing but the price levels, and maybe, or at least have a chart that is free of any of the noise that you get from indicators. I'm a pivot trader. I want to have pivots on charts, etc. However, I feel quite confident trading without them, and that's only picked up by trading without them at times. I'll look at certain charts and certain strategies I'm using, and I'm not looking. I might use a 34 moving average just to give a bit of a clue to where the trend might be sitting at a time, or if I want to set it into more of a mechanical type trade as opposed to a more flexible trade. or visual trade. So if I can see it, it's in a trend, well, I'm okay with it anyway. The 34 would only tell me if it's above the 34 that it's more likely in an upward trend, and vice versa. So here's a challenge to you, is to start reading price and look at old-fashioned higher lows, etc., to give you sort of, if you want to see a market that's turning into a different sort of shape, you start looking for the weaknesses, the weaknesses as in the movements and the frequency of it pulling back in between moving to the low side. So here, for example, so from here you're seeing this movement, and it pulls back, pulling a decent movement, then pull back, then pull back, and it's pulling back more and more frequently, suggesting that, well, the market might want to be, or there's more buyers coming into this market. I say the market might want to be doing something. The market doesn't want to do anything. We talk about it like it's something that's live, and the only thing live about it is the traders that are trading it, not the market itself. And the volatility in the market's again driven by traders, so it's really psychology of other traders. And always, and I guarantee always, there'll be a whole stack of retail traders. When this is coming down like this, they'll be wanting to buy. Eventually they'll be buying, the market will roll over, they'll lose, they'll buy it again, it will lose. They might buy it again, but it's starting to think between what would have probably been divergences here and here, at this stage they start getting the jitters. You know what happens next? It starts moving up. They buy. Well, what's it do? It comes back down again. So the whole thing about trading and using indicators and buying at the wrong times, look at what's actually happening when you're seeing this. Well, yes, there is the chance at this stage it can be turning. Two lows next to one another. Let's clear this off for a moment. Two lows here, there'll most likely be divergence, because the way price is calculated and most indicators are calculated, there'll be divergence. It's moved up, so some of the numbers would be adjusted accordingly, so the calculation would give you a divergence. You don't need an indicator to tell you that. You can look at an indicator and it will confirm it, most likely. Let's have a look. Let's put a RS. Oh, I can use it. I could just look at the as it happens, the stochastics actually give me it, but there we go. RSI. So you've got this low here, lower RSI. You've got a new low, slightly higher RSI. You've got a new low, higher RSI, even more. So you've got these higher RSIs. So it's showing you. Do I need an indicator to tell me what I can see on the chart anyway? And that's the question where I challenge you to, as I say, take a chart, leave out the indicators, or just use it as an exercise and go back and start reading the price. Looking for these areas. Well, potentially it could sell here. It's weakening. It's pulled back in between. There's indecision possibly. Yes, it might go up again. Well, how do I get into this trade? And what I suggest is, well, there's a simple way, is the way Wells Wilder, when he was looking at RSIs, what he did do was show us a way of getting into a trade that might be weakening, and that's taking the breakdown of the low between the two highs. That's when it's starting to get softer. That you don't have to try and be selling up here, because forever people that are trying to sell at the top, and I've been one of them. You're hearing from a converted trader, poacher, effectively, a poacher turned gamekeeper. At this point, I'm looking really for the safety, so I don't need to be trying to be selling up here. I can wait for the signal to come in. I can even wait a little bit longer. We traded this yesterday. It came in, it gave us a lower high here, so we had the weakness up here. Could have got in a bit earlier. In fact, it was just somewhat safer here with a lower high coming through, and then off it went. Now the signs of the market are there. Again, here we exited half a position pretty close to the low. Why? Nothing particularly clever. I just looked at what the monthly plans were doing, and we came out. Sorry, I've looked at move charts here. Let's get us back in. There we go. Let's just put a monthly chart on here, make this monthly, and you'll see why. Well, look, there'll be buyers coming in at this level. So what do? We take some profit. Not all of it, we're taking some profit. Will it rally from here? Possibly. So we don't know. Is it giving us signals that it's going to rally from here? Only historically, where it comes back to previous lows, there's the potential of buyers coming in. So at that point, we can consider the idea of actually, well, closing part of a trade at that point. As we come down the time frames here, you'll see it's actually since that low has been put in, it came up it's pushed up quite a way. And is coming back up in that way. If it breaks the 106 area here, well, it'll put a clear higher low in, and perhaps it's going to see some more upside. What will be happening down here? Of course, buyers will be coming into the market down here because of the prior lows. That's fine. Don't kick it. So we want someone to be buying there because we want to be selling part. So that's fine. The key thing is learn how the price action's moving. Lower highs, lower lows suggest downside. Higher lows, higher highs suggest upside. Just write that down, run through the charts, start having a look. Look at for weaknesses where you're seeing the price action come through here. It pulls up, makes a lower high between this previous high and this high. That's weakness. Look at how you might have traded it, how you may have entered it. Do it all with nothing on there apart from maybe you could put some horizontal lines on from previous highs and lows. That's fine. That's not using anything apart from the historical price, but that they work well, and you can use some trend lines. But they're the things that you can build up on a empty chart, and a chart which has just literally got the price action. When you start mastering that price action, then you start mastering trading in a much better way and understand really what's going on, particularly if you're flittering from indicator to indicator to indicator. Of course, there's nothing wrong with using indicators in terms of they give you an edge. If it helps you use that to design automatic trading or whatever it may be, that's fine. But get used to reading the price action first, then consider maybe one or two indicators and see if you really need them. As I said, with a RSI divergence, yes, sometimes I look up at things like this and I think there's a divergence. I'll click on the RSI and there's no divergence there, and it's maybe because it was too close. In this particular case, there was a divergence. There we go. You don't need an indicator to tell you what most likely happening. The indicator is only taking the price action here and suggesting, well, there's a weakening of price action, nothing more. So there you go, the challenge is set. Let me know how you get on. Now if you want to come and join me in my live trading room, there'll be a link down below. Just click in and register, and I will send you an email when I'm running the next sort of period of morning trading, so you can just come in the mornings and trade with us and see how you get on. I spend a lot of time reading purely price, so that might help you. Okay, I'm going to cut it here. Have a great weekend, as it's a Friday when I'm recording this. If you're watching it later, have a great time, but the link will still be down below. Take care. Bye for now.